Your read is often a little bit different to most people on the street. Give me your read of this payrolls report this morning, Danny.
Well, obviously, we're still seeing labour market recovery. There's quite a lot of difference between the last month's numbers, which were actually revised up. So you've got over 330,000 jobs created. I think the reality is that people don't seem to have understood that the point of the Fed raising rates is to raise the unemployment rate and slow job creation and slow the labour market. Their view is that the full employment rate, if you like, of unemployment is about 4.8%. With the economy at 4.1, they think there's basically exploding wage pressure, and they're trying to raise the unemployment rate. So I think that's a fundamental mistake. If you like, it's the background to the Trump tax cuts intended to boost the economy, and the Fed is trying to slow the economy. So that's, I think, the background to this. I look particularly at production and non-supervisory. That's still pretty darn weak. Much of the wage growth is coming at the top end, so people in the heartland aren't feeling things. And I think the fundamental mistake is that the US is a long way from full employment, and that's why there's no really big wage pressure. Remember, wage growth was about 4 prior to the recession. Workers don't have much bargaining power. We're a long way from full employment. But my old friend Ed is right. Global growth is coming, but this looks like as good as it gets, and you expect to see volatility going forward. The Fed is trying to raise the unemployment rate.
So Danny, outside of the fact of whether you think the Fed's trying to raise the unemployment rate, if this is as good as it gets...
Well, it is.
So what's the Fed's role if this is as good as it gets? Because if there's a downturn around the corner, they need to have the ammunition to respond to that.
Well, of course they do. Everybody's argued that, but the counter to it is the following. You want to raise rates so that when the recession comes, you can cut them, but you cause the recession to come by raising them too soon. It looks to me to be a fundamental mistake. You should not be raising rates right now. You're going to cause that recession to come along. So the two things contradict one another. You cause the recession, and yes, then you can cut rates, but you cut rates because you caused the recession.
But Danny, what's been fascinating about the last couple of years is the Fed has been raising interest rates, the labour markets continue to improve, and financial conditions haven't tightened. They've loosened, Danny.
Well, I mean, everything takes a while to come through. I mean, the reality is that I said at the beginning, recovery is coming. I think in May, this becomes the second longest recovery ever. And by June of 2019, it becomes the longest recovery ever. There are cycles. So, yes, things take a while to have an effect. Fed raises rates. It takes 2 years or so to really have any impact. The worry is down the road. I mean, there's no inflation. Why are you raising rates when there's no inflation?